The companies will be Baidu. Paul, what's Baidu again?
Baidu is a Chinese search engine. Just like Alibaba being in China, I do want to exhibit some caution. And if you actually look, when I log into my Merrill Lynch account, there's a big warning that says, there's a warning about Chinese companies, like we are concerned about the financials of Chinese companies. So this is not just me being some terrible human being who's just being raised. It's not at all. There are concerns about the legitimacy of the numbers coming out of China. We are still going to look at these numbers as if they are authentic, and we will go from there. But Baidu is the largest search engine in China. So let's start with that. So Seth,
what's the market cap? Yeah,
$86 billion.
Thank you, 86
Okay, so
bill.
it's a pretty large size company. PE ratio is 26, so it's an X to start. But something tells me there's a lot of potential growth. So we're going to look at that and see. It's China's a very fast growing country in terms of people becoming more economically wealthy. And as they become wealthier, they're going to also be using the internet more. So I would look at it that way and say, oh, there's a lot of potential in China. Does that make sense?
Yeah, pillar number 2 is profit margin. We want this greater than 10%, Paul.
Okay, here's my first red flag. It's 48%.
Uh-oh, okay, hold on right now.
They have a gross margin of 54%, so they're basically saying that their costs are 6%. It's a check mark, but that's immediately my what's going on. Now, I will say this. That was last quarter.
Okay.
In the last year, it was about 20%, a little over 20%.
Okay, not bad.
Okay, so not bad at all. All right?
Let's do revenue growth over the past 5 years. Is this company 5 years old, Paul?
Good question. I don't even know.
Yes,
Yeah, very
10
much
years
so.
old. Okay. Revenue growth, pillar number 3.
Okay, wow, 10 billion to 11.3. So actually, the revenue growth has not been a lot.
No.
It actually went from 10 to 9.7 to 10.8 to 12.4 down to 11.3. It is still a check mark because it has growth, but it is not a huge one. We can look later at its trailing 12 months.
Profit growth, pillar number 4. Oh, Paul, you're whistling.
5.4 down to 300 million.
Come on.
So something happened here. There was some big expense here you got to look at. This doesn't happen just, look at the last 10 years.
Billion and a
Billion,
half.
billion seven, 2.1, 1.7, 2.7, 4.2. So they had some big write-off or something. That doesn't worry me as much. You got to make sure, guys, when you're doing further research, that you find out what was the big one-time write-off or one-time charge they had that dropped this. Just like if it was a one-time gain because they sold a division, you wouldn't count that one-time charge.
Like an acquisition?
No, not an acquisition. It would be something like, not to get too much in the, it's a great question though, Gio. It's something like, let's say they bought another business for $5 billion. So it's on their books for $5 billion. Then they realize, oops, we screwed up. The business is actually worth $1 billion. They have to write off $4 billion of that cost. So that's the kind of write-off we're talking about. As long as it's a one-time occurrence, you're okay. You don't want your company still making bad investments, but you still want to sit there and acknowledge the fact that a one-time charge is okay to ignore.
Let's go to pillar number 5, which is shares outstanding. We want these going down.
Okay, 349 down to 348. So barely down, but still down. And I found this a lot in foreign companies, European. They don't do a lot when it comes to buying back shares. Like European companies tend to stay pretty consistent. Chinese company tends to stay pretty consistent. I don't know why that is. That's going to be something I research more. I'll have my trusty assistant, Gio, research more. But it is a check mark nonetheless.
Pillar number 6 is current assets greater than current liabilities, Paul.
So 24 billion is the current assets, and current liabilities, 9 billion. Plenty of room. In fact, huge one. They only have 19 billion in total liabilities. So this is one of those big mother effing check marks there. They have more cash on hand than the entire company has in liabilities. So this is a good thing.
That's great.
Free cash flow growth is pillar number 7. Thanks, G. Free cash flow growth, which is the cash from operations minus capital expenditures, and we want to find.
And this is the money they use for dividends, buying back shares, making those acquisitions, etc.
Right.
Now it's actually not as good as I thought it was going to be.
Free cash flow.
Yeah. So it's a higher percentage than I expected. So what's it called? 5 years ago it was about 1.9 billion, and recently it was 1.4 billion. So it's actually an X. And then 1.8, 2.8, 2.1.
The free cash flow average over the past 5 years is 2, Paul.
2. Now, remember, there was more cash on hand than total debt by about $5 billion, right? So when we do our number, we want to add $5 billion to it as what we're willing to pay for the company because it was a net $5 billion extra. Does that make sense?
Okay.
If you're buying a company for $10 billion and it has $3 billion in debt but $5 billion in cash, you're essentially getting that $2 billion extra because you can take that $5 billion, pay off all the debt, etc. So here, this isn't a fast-growing company. I actually feel like, I mean, 15 to 20 on the high side. Now they do have a lot of potential. Maybe 20 is fine. So 40 plus $5 billion, $45 billion. Guys, it needs to fall in half. Because right now it's a $90 billion company.
The current market cap is 86. This is what the world thinks this company is worth. And through Paul's analysis, you're coming up with it's worth 45 billion.
40 to 45 billion on the high side. Now, because remember, the growth wasn't big. We didn't see a lot of growth. The growth was very small. In fact, they were decreasing their revenue in the last couple of years, and their profit plummeted. So before you buy a company like this, even if it's at the right price, let's say the company was selling for 30 billion right now, and it's well under the number, I would still caution you, say, make sure you go do your research to understand why revenue is not going up and why profit's down a lot. You need to understand those. Also, those numbers are from the end of 2019 because 2020 is not finished yet. So one of the things to look at is how the last 12 months have gone.
What do you mean 2020 is not finished yet?
So in the accounting world, it's only January 14th. The year ended December 31st, right? However, it takes a long time to get your books all finished. I mean, these are big companies, so it takes them a while. It takes them usually a month to get all the books ready to release to investors.
So to regroup, this is Baidu, the Chinese company. The PE is no good. Their profit margin is very high. The revenue is up, but the profit is down. Shares are going down. They have current assets over current liabilities, which is great, but they do not have a steady stream of free cash flow that's increasing, and their overall market cap, in our opinion, is a bit high, Paul.
I do think it's a bit high, and it actually is consistent with their PE of 25. I just think to myself, you got to wait for a lower price.